Welcome back. We are excited today to talk about what was our most popular video from last year, the important numbers to know from tax and retirement for this coming year.
Andy, let's say Happy New Year. It's
Happy New Year.
2024.
Happy
Come
New
on.
Year.
I got to teach them everything.
We hope everyone had a great Christmas and New Year's. We're excited about this coming year. And we're excited to bring you some good updated information that we think will be useful, that we'll be talking to clients about, especially at the beginning of the year. So beginning and end of year, we want to update our contributions. We want to be planning for tax. So we're going to hit on a lot of the main ones that we think are important to know. Updated for 2024. So with cost of living increases and inflation, the IRS updates the contribution limits and the tax brackets to account for those increased levels. So we're going to give you a lot of those today. First to note, from a tax standpoint, the marginal tax brackets have all increased from last year. We're going to pull up the slide so you can see what those ranges are. But again, same tax rates, which are set to sunset in the end of 25. So come 2026, these could revert back to where they were before. But for now, we've got the 10, 12, 22, 24, 32, 35, and the highest marginal income tax rate being 37%. You'll see what those ranges are. And the main important thing to know is what your effective tax rate is, or your blended rate. So even though you may be in the 32% bracket, that's not going to be the true tax that you're paying on all of your income.
Or to know your marginal rate, which is kind of the highest bracket that you're in, because if you're able to deduct from your income, that's going to happen at the highest rate. Or if you're looking to add income, maybe you're in the 10 or 12% bracket, we try to plan with that. That's a great opportunity to get some money out of a retirement account, add some income.
Right. Or if you're considering Roth versus pre-tax 401k, know what that marginal rate is, like John was saying, to know what that tax savings will be.
But in addition to the brackets inflating, the standard deduction has also gone up. In 2024, married filing joint, your standard deduction is $29,200. Single, it's half that, $14,600. And then also, if you're over 65 or blind, there are some additional standard deduction that you get to add in. So make sure to be aware of that. I think sometimes on different tax softwares, you actually have to choose that to make sure that you're getting it, but you would think they would all know it by your birthday.
Right. In standard versus itemized, you get the higher of the standard deduction that's given to everyone, or itemized deductions if those add up to higher than what you're seeing on this slide. So
yeah, capital gain tax rates, if you're in the 10 or 12% bracket, long-term capital gain tax is 0% still. But once you get over that, you can jump in, or you'll start being taxed at 15%. And let me back up. Long-term capital gain means you bought an investment, you held it for more than a year, and you sold it for a profit. If it was less than a year, it gets taxed as ordinary income, the gain amount. But yes, once you get married filing joint, again, once you get into the 22% bracket, you start paying the 15% long-term capital gain rate. Once you're over $583,750, that starts jumping to 20% long-term capital gain rate. But there's also the net investment income tax, also referred to as the Obamacare tax, the Affordable Care Act. It's a 3.8% tax on investment income. You need to be aware of that once you're modified adjusted gross income. So it's not even just adjusted gross income, they modify it, they take it a step further. If that's over $250,000, your capital gains get an additional 3.8% tax. So effectively, your long-term capital gain rate can be almost 24%.
Moving on, Medicare. So for those over 65 on Medicare, the Part B premium, which is your primary health insurance if you're on Medicare, that has gone up from about $165 to $175. So $10 increase. That's going to also be offset by an increase in Social Security, since Part B comes out of your Social Security before you receive it. But there are also there can be IRMA, income-related adjustments, added on top of that if you're at higher income. We're going to show where those Part B and then Part D, your prescription plan, where those IRMAs begin. So let's talk about a number that does increase every year, retirement contributions. Specific 401k does, IRA, it's kind of every few years it feels like. You'll see here the pre-tax, pre or Roth 401k contribution. This applies to 401k, 403b, 457, but we'll leave it at 401k. It increased from $22,500 to $23,000 if you're under age 50. If you're over 50, you can do an additional $7,500. Now these are for employee deferrals to 401k plans. And so you can even do a Roth contribution that's well over what a Roth IRA max contribution is if you're using that in your employer 401k plan. Because you'll see IRA contributions, they increased from $6,500 to $7,000. If you're over 50, an additional $1,000. So under 57, over 58. And again, those are the same for IRA or Roth, and it's the total max. So you could do 3,500 Roth, 3,500 IRA, but it's the total for all.
Between the two, and that's referred to as a catch-up contribution, that extra $1,000 if
Right.
you're over 50.
Right. Let's see. SEP IRA for those that are self-employed. For self-employed, you can do a SEP IRA. We also have clients that want to do what's called an individual 401k. But for SEP IRA, you'll see the contribution limit went up to $69,000. It's also, that is the max you could put in. You may be limited by your income as to what you're actually allowed to. It roughly equates to 20% of your net self-employed income.
For IRAs and Roths, you've got to be aware of the phase-out limits there. Everybody can contribute to a traditional IRA, but not everybody can deduct that contribution to a traditional IRA. So it really depends on, again, what is your modified adjusted gross income, and are you or your spouse covered by, are you a participant in a workplace retirement plan? So if you're married filing joint and you're covered by a workplace retirement plan, yeah, if your modified adjusted gross income is $123,000, you start getting phased out of being able to deduct your IRA contribution, and if it's over $143,000, you get no deduction. Now, that's not always, I guess, yeah, if you want the deduction, that's a bad thing, but there are also strategies that we actually intentionally do IRA contributions knowing we're not going to get a deduction in order to do the backdoor Roth IRA.
Which I believe we've done another video on.
That is true.
Go to our YouTube page, and we get much more in depth there.
For Roth IRAs, excuse me, I've got a little bit of a cold. That's why I'm drinking some coffee over here too. For Roth IRAs, it doesn't matter your workplace retirement. If you're participating in a company retirement plan, it just matters what is your modified adjusted gross income. So married filing joint, if that becomes $230,000, you start getting phased out of being able to put dollars into a Roth IRA. If it's over $240,000, you can't make that contribution. So it's important to keep these in mind, especially if you're having income increases and you're getting up to that limit. Required minimum distributions. The only thing we'll put up the factors, to determine what your required distribution is. You take the December 31 balance. So right now we'd be looking at a December 31, 2023 balance. And then based on your age, there's a factor that you divide that balance by, and that tells you how much you need to take out of the IRA. Don't forget about qualified charitable distributions though, especially if you're taking a standard deduction and you are subject to a required distribution, or even if you're just 70 and a half, because you can actually do a charitable gift, but that's where you send money from your IRA to a charity. And so if your required distribution was $20,000, well, if you take 5 of that and send it to a charity, that satisfies some of that required distribution, but you don't have to report that $5,000 as taxable. So you're essentially getting a charitable deduction, even if you're not itemizing on your return.
So you got the tax break on the front end and you're not paying tax on the back end. So again, that's with 501c3 charitable intent only. It can't go from John to me or to any family, etc. But you can pay the tax and then give me
Oh, sure.
Give me the net.
Let me do that.
All right, HSAs, health savings account, one of our favorite savings vehicles because it has triple tax preferential treatment. You get a tax break on the front end. You don't pay tax on the dollars contributed. You can actually invest it while it's within the HSA, grows tax-free, and then withdrawals for medical expenses, qualified medical expenses, and that list is very broad. They come out tax-free. So there are rules and requirements around it. You have to be part of a high deductible health plan. You'll see on this slide, this is the minimum deductible required for your plan. So for individuals, $1,600 deductible. For families, $3,200. But assuming you qualify, the contribution limits are $4,150 for individual, $8,300 for family, and then if you're over 55, you get to do an additional $1,000. So if you're over 55 and on a family plan, you can put $9,300 into an HSA. Obviously, you're getting a tax break there based on your marginal bracket. You can invest it. You don't have to use it. It's almost like a tax-free medical retirement account. So we're big fans of it.
Yeah, once you're over 65.
Yeah, I didn't touch on that, but yeah.
Yeah, I mean, an HSA is hard to go wrong with because, again, we're all going to have medical expenses. But once you're over 65, you can actually withdraw from an HSA without the 10% penalty. You'd have to pay income tax. For it not
being medical related.
Yes, for it not being medical related. If you just want to do it on anything, you'd have to pay the income tax. But that's essentially the same thing as a retirement account. You've got a deduction when you put it in, and then later when you take it out, you pay your income tax. So an HSA is just you got a favorite term for it.
Remind me.
You said something about a healthcare retirement account, or
yeah, it's like a healthcare Roth, but that you got a tax break on the front end. Was that it? Yeah. I'll come up with something better than that. So, yes, that's what to know on HSAs for 2024. We're in 2024. That's right.
For estate tax, the lifetime exemption has increased a little bit. It's now $13,610,000 per person. If you're over that, it's a good problem to have, but it can be a problem because it's a pretty hefty tax.
It quickly gets up to 40%.
Yeah, 40%.
On what's
right.
over that, yeah.
And the annual gifting exclusion is $18,000. That's just how much an individual can give to someone. Andrew's really needing me to give him some money, apparently. So
these kids, man.
And yeah, you, Lindsay, Charlotte, Lily.
That's right. So if you're married,
$72,000 I could give you this year. Your family
doesn't even need Excel. Excel King.
But it's important to know that this again is subject to the sunset potential. So after 2025, I think this number may get cut back in about half.
The estate tax.
Yes, the estate tax.
Not the gift.
The estate tax.
Yeah, the estate tax. But yes, so for 2024, husband and wife, or a married couple could give 36 to any individual person, and you can hit those 36 to however many people you want. Great way to, if you are going to have an estate tax issue, which that's a good problem to have, like John says. It means you have more than $13.5 million in your estate. Good way to move assets out of your estate to family members, friends, whoever it may be, without ever paying tax or having to file declaring that. So last topic we wanted to touch on was Social Security. There was a 3.2% increase in your Social Security benefit for 2024. So you'll see that on your January deposit. That should offset that $10 increase on Medicare. So you should feel it, not as much as you did last year. It was an 8.7% increase, cost of living increase, because inflation was running so hot. They look at it in, I believe, October of the year to then decide what it's going to be for the coming year. So that is an increase that you'll see. They also raise the income limit on which you pay Social Security tax. So for 2024, that was increased to 168,600. Last year, I want to say it was 157 and change.
I'll be fact checking this.
Uh-huh.
It's dangerous to go off memory on that one.
Some numbers just going to pop onto the screen
Yes,
there, isn't it?
I got you.
Okay, I'm going to say 157.6.
Closest without going over?
All right, go ahead.
Oh, what do I think it is?
Yeah,
You said 157.6?
yeah.
157,601. I watched The Price is Right.
So if you're at 168,601 on that $1, you pay no Social Security tax. So over and above, no Social Security, but you are still paying Medicare tax. And let's see, John, anything we missed?
I think that about covers it. I mean, we hope this is just good information to start the year off, get you thinking. With the retirement increase limits especially, we'd encourage you to go ahead and make those changes, because if you can spread it out over 12 months or 24 pay cycles, or 26 if you're every other week, it's just a lot easier to absorb than trying to catch up at the end of the year. So definitely go and check, are you set to max it out regardless, or is it set to a percentage of your income? We can help you kind of calculate what you'll be tracking for the year.
Yeah, with the goal being increasing every year, right? So as these dollar amounts go up, think of it more as tied to a percentage of your income that you're trying to put towards retirement and savings. That kind of keeps you on track to make sure you're not, outspending those annual increases in income. And we want clients to get to the point where they're maxing. And once you do, you really don't think about it, right? So you're just going to continue to, with that percentage, max it out. That's a great goal to have, because a lot of folks, they might have a 3% employer match, and so they do the 3% to get all the employer money, but that's
the minimum.
That's the minimum. That's not going to, that's probably not setting yourself up for success. So that's why starting early, getting into the behavioral side of knowing these numbers and updating contributions sets you on the right track.
We hope you enjoyed these videos. We're going to be doing a Social Security webinar in a month or two. We'll do that. We'll send out information on it. We'll get questions ahead of time. Andrew and I are going to be just having a conversation with an expert from BlackRock. Nuveen, that's right. We've already kind of spoken with him, and he's pretty interesting to kind of hear his take, and we'll take live questions on that as well. So it's just good information. Share, let your friends, families, colleagues, anybody know. Anybody's welcome to join it. So.
Yeah, we want you to win the Social Security game. Get as many dollars as you can out of the system. Thanks for joining us.
Happy New Year.